We are still on chapter 7. Have you noticed that we are studying the elements of the balance sheet so far? We started with, I think we started with inventory, the one we are on right now. And then next chapter will be cash. Then the chapter after that will be accounts receivable. Notice these are all elements of the balance sheet. And hopefully one more will be long-term assets or fixed assets. We're going to go through that order, yeah. And the long-term assets, we will study the depreciation. Yeah, how the methods of depreciation, straight line, for example, straight line methods. We production method where you consider the life of the truck, for example. The life is in units instead of years. For example, we say a truck that will last 60,000 miles or 100,000 miles, like that. That will be the life. And then we also declining balance methods. Those are the ones that we will learn. Yeah. Okay. We talked about the cost flow assumptions yesterday, the average method, the FIFO, LIFO, and specific identification method. And today we have two more methods that we're going to learn. And there will be pages 277, starting page 277 and 278.
The retail method and the gross profit?
Yes. These methods are used when you have to estimate the inventory. Okay, like for example, if a fire happened in your place. If a fire happened, how do you come up with your ending inventory? You have to do an estimation. And the way to do that is by using these two methods. The retail inventory methods. Now, if you look on next page, if you look on the next page, you will see there is an example, Exhibit 7, page 278. Notice that you have there is a ratio, it's called cost to retail. Cost to retail ratio. And this will be, and you can see in this case is 75%. This method is not that easy to estimate. I think the gross profit is a little bit easier than this one. So let's go on. And now the basis of these two methods, if you remember the skeleton of the income statement, beginning inventory plus net purchases equal available for sale, cost of goods available for sale, and then minus ending inventory. Sorry, that gives us beginning. Okay. This is cost of goods sold. Sorry. Yeah. Cost of goods sold. Beginning inventory plus equal available for sale minus end inventory equal cost of goods sold. Now this, if you notice, both of these methods are built during that, built based on this formula. So if you look at the retail inventory method, notice that we started with beginning inventory at cost and beginning inventory at retail. Okay, see the difference between the two? One at cost and one at retail, that means at the sale price. So if you look at beginning inventory, you have 80,000 at cost, and at retail 110,000. You see that? And then if you add net purchases for the period excluding freight in, without freight in, it was 214,000 at cost and 290,000 at retail. And then you have freight. The freight is 6,000. Notice, why do we have a freight under cost and we don't have freight under retail?
Cause retail is what you're selling. You're not selling like your shipment.
Yes.
Coming in, cause your shipment coming in, you gotta open up the box.
Yes, sir.
and put that stuff that's in the
Exactly.
box out.
You retail may include freight out, not
You gotta
freight
ship
in.
something
Yeah,
out.
it may include the freight out, but not in. Yeah. So the cost of goods available for sale at cost is $300,000, and at retail it is $400,000. Now we need to find this ratio, cost to retail. Cost to retail, that means you divide the available for sale at cost divided by retail, and then you get your ratio. And this is the ratio that we will use. Okay, usually because you are going to estimate your ending inventory depending on your retail in this case. If 75% of your retail is cost, in this case, that's why we need this ratio. 70% of the retail is, in this case, is a cost. And the other 25% are markup for your retail. So, and then sales during the periods were $320,000. Okay, if you take those out of your available for sale, and therefore your ending inventory at retail is 80,000. Your ending inventory at retail. Now, see, that's what we're looking for. We're looking for ending inventory at
Retail.
cost. Now,
Oh,
we are looking for ending inventory, the cost of ending inventory. And we're going to use this ratio.
okay.
You see the point here? So, ending inventory at retail is 80,000. So what is 75% of it? 60,000. That is your estimated, all right? This is estimated cost of ending inventory. Got it? Okay, that's estimated cost of ending inventory in this case. Why do we find this ratio? Because we're going to base this ratio in figuring out or estimating ending inventory at cost. Okay? Got it? Yeah. 75% of your 80,000. 80,000 times 75%. You should get 60,000, yeah. Okay, so this is a retail inventory method, yeah. And then the second method that we use when we do the estimation, we do the gross profit, is kind of a little bit similar, but in this case, instead of using the cost to retail ratio, we have the gross profit ratio. Okay, so you look at your this example again, Exhibit 8, you will see beginning inventory 100,000, cost of purchases 580, available for sale is 680. Notice that this is the available for sale, correct? And then we are going to deduct the cost of goods sold from it. So if the available is 680,000, take from it 800,000. I mean, sorry. This ratio will be given to us, by the way.
Oh, okay.
Yeah, this ratio will be given to us. This is a gross profit ratio. That's why we call it gross profit method, because we use that ratio.
So I see how it's separating.
So,
you don't have to find a ratio.
Yeah. If the sales are 800,000, okay, this will also be given to us. The sales are $800,000. 30% of that is cost. I'm sorry, let me take it back. I apologize. 30% of that is profit.
Oh,
and the rest of it is cost. So 800 times 30%, you should get 240,000.
Yep.
Now, so estimated cost of goods sold is 560, which is 800,000 minus 240. Remember, this is the sale price, 800,000, all right? This is the sales. If the profit is 240,000, then the rest of it must be the cost. That makes sense?
Yes, sir.
All right. So 800,000 minus 240, that gives us 560,000. All right. So the available for sale is 680,000 minus cost of goods sold,
Yes, sir.
560,000. You get 120,000. That is your estimated ending inventory. Okay? That's your estimated ending inventory. Okay, so now we covered all the chapter 7. Now we're going to do some practice. And then after the practice, we'll see if you have any questions about the exam.
Yes, sir.
Did you give me chapter 3?
Nah, I'm working. I'm gonna give them all to you at once. So
Huh?
I'm gonna give them all to you at once. That's why I'm still working on all of
It's better whenever you finish one.
them. Turn it. Okay.
Yeah, so I can enter your grade. Yeah,
Okay, I'll do that.
yeah, I sure need those. Yeah.
Yes, sir.
All right. So if you, I chose some exercises for us. Go to page 291. Go to page 291 and look at E4A. Exercise E4A. That's problem set A. Problem set A. Let me see if I can, for explanation, for the ones who are probably going to be observing us, let me go to Excel. And maybe we can use that. All right. So we are basing our numbers on, we're basing our numbers on, is this your homework?
Yeah, so this my the two
Oh, this is the case?
case study 2 and 3.
All right, thank you. Appreciate you.
I like the case studies.
Yeah. Let me put these over here. So, we are using the periodic inventory system. And if you look at this example, E4A, January 1st, beginning inventory is 150 at $30. And then we have a couple of purchases. And we have one sale. Bless you. We have one sale. And then we have another purchase. Now, can you tell me how many units we have in ending inventory?
Okay, so
We started with 150.
then you add 400,
That would be 550.
add 800.
That would be.
I'm about to put in my calculator.
All right, go ahead and do that. 150 plus 400 plus 800.
150 plus 400 plus 800. So far, you got 1350.
Minus 1300
You got 50 plus 300.
plus 300.
So it'd be 350.
So
Right, and then inventory 300.
ending inventory is
350.
350 units.
Yes, sir.
Now, so let me write just this note over here. Ending inventory. Ending inventory is 350 units, correct?
Yes, sir.
is 350 units. Okay, the question saying number one, using a periodic inventory system, compute cost of ending inventory, cost of goods sold, and gross margin. All right, and gross margin, use the average method. Let's use the average method first. Okay, let's use the average method first. So remember, we need to put the available for sale. The available for sale beginning inventory is 150. Let me go back to here. Beginning inventory is 150. Inventory 100. I'm going to put that on this 150 units at
$30 per unit.
$23 per unit.
30.
30?
Yes, sir.
No. Oh, yeah, I'm looking at the top one. Yeah, 30. Yeah, $30 per unit. $30. And then we have a purchase. Okay, I'll just put the letter P. Purchase on June 4th. Purchase on June 4th. How many did we purchase?
400 units.
400 units at
$33 a unit.
$33. And then we have another purchase. Purchase on
The 12
on the 12.
for 800 units.
On the 12, we purchased another 800 at $36. And let's just put all the purchases.
Oh, okay.
Okay, and another purchase.
24.
Okay, a purchase on
The 24.
24th, on the 24th. How many?
300 units
300 units
at $39 per unit.
at 39. All right, so if we multiply the available for sale is all of these. So if we add all of those, 1,650, the available. And if we multiply equal product of B7 and C7. All right, so that's 4,500. Right click, copy, and click and paste. That doesn't make sense. 28,000. What's 300 times 39?
300 times 39.
Uh-huh. I think that's correct, looks like.
9,700.
All right. So the available for sale, add all of those. You're going to get 58,200, correct? 58,200. All right. Now we want to find the average cost per unit, because they are asking us compute the cost of ending inventory, cost of goods sold, and the gross margin. Use the average cost. Under the average cost, we're going to divide. Okay, so let me go back down here. Under average cost, unit cost is unit cost is going to be, oops, FT.
Oh, so we had to buy 58.
Yes, 50 58,200 divided by 1650, and that should give us, okay, what would that give us? 35.27. All right, that's the average cost per unit. So how many, bless you, how many units we have in ending inventory? 350, correct? So ending inventory equal ending inventory is equal to 35.27 times, I put the times as a star, times 35, I'm sorry, times 350, and that gives us, what would that give us? $12,344 and is 44 point what? Yeah, let's say 12,346. 45, sorry. Because if you want to put it to the nearest. So this is our ending inventory. All right? Once we find our ending inventory, we can easily determine cost of goods sold. You remember, cost of beginning inventory plus purchases equal available for sale minus ending inventory. Now we know ending inventory under the average method. So if we want to find cost of goods sold, we're going to say beginning inventory, which is 4,500. Okay, beginning inventory 4,500. Okay, plus all purchases, the three of well, why don't we do just, we know that's equal available for sale is 58,200. You don't have to add it. We don't have to have beginning inventory plus purchases plus purchases equal available for sale, correct? Available for sale. In this case, how much is available for sale? 58,200. All right, 58,200 minus ending inventory, which we found, less ending inventory, which is
12,345.
okay. 12,000, which is ending less ending inventory 12,345, and that gives us
It's gonna be wrong, Doctor. You gotta type in available for sale, right? You only type in 5,800. You need to add a 2 into between the 8 and the 0.
58,200. Yeah, 58,200.
You just got 5,800 right there.
Oh yes, sir. 58,200. Yeah, minus 12,345 minus that, and that give us
45,855.
all right 45,855. So that is our cost of goods sold. Now, what is the gross profit? Go back to the skeleton of the income statement. The skeleton of the income statement. Net sales minus cost of goods sold equal gross profit or margin. All right. So if we go down here, we're going to say net. Let me write it down. Sales minus cost of goods sold. Goods sold equal gross profit. And both of these are available to us now. Sales are, how much our sales? 13 units times 60, our sales.
1300.
So sales equal 1300 units times, I'm going to put the star as times 60 equal times 60 equal
78,000.
78,000. All right. So this is sales. All right. Okay. So now sales minus cost of goods sold. Sales are 70. Let me go back to here. Sales are 78,000 minus cost of goods sold is
45,855.
45,855, and that's equal
32,145.
32,145. That is correct. Okay, so if again, I wish I can use the pencil or something to circle. So under the, all of this is under the average method. Under the average method, okay, ending inventory is 350 units, and 350 units times, once we divide the total available for sale by 1650, we get a cost per unit, okay, which is 35.27 multiplied by 350. That gives us ending inventory using the average. Okay, now we're going to do ending inventory using the FIFO. The second one is FIFO. FIFO means that the sales are, the first thing we get must be sold. That means sales are going that way. We first have to sell the 150, then the 400, then the 800, then the 300. That's FIFO. All right. So we sold everything except 350 units. So we sold this one, we sold this one, we sold this one, except 350 units. So let me go down further now.
So we sold all those except for the purchase on the 12. We got 50 left of that, and we still got all the units. For
Yes, sir. So let me just put FIFO, FIFO. Okay, and then let me increase the font. And underline it. So under FIFO, okay, ending inventory is end inventory is, so we have a 50 units at 36, 50 times 36, and that's equal 1800.
Yes, sir.
All right, and 300 times 39. 300 times 39. What do we get? Equal
11,700.
11,700. So ending inventory is both the 1800 and 11,700, and that's equal to what?
13,500.
13,500. Okay, 13,500. Okay, now how did we get that? 13,500. We added 1,800 and the 11,700. Got it? We added 1,800 plus 11,700 and we got a total of 13,500. Okay, now we need to find cost of goods sold. Available for sale, we already know. Cost of goods sold, one more time. Okay, available for sale minus ending inventory equal cost of goods sold. All right, available for sale is what? Available for sale going back is 58,200. All right, 58,200. 58,200 minus ending inventory is 13,500 and equal what? All right. 44.
44,700.
Yes. 44,700. That is our cost of goods sold. Now, the gross profit or margin is going to be our sales minus cost of goods sold. So gross profit, we don't need to repeat the formula. The sales are 78,000, correct? The sales, we already know what the sales are. Sales minus cost of goods sold equal gross profit. Well, gross profit. And so therefore the sales are 78,000 minus cost of goods sold 44,700, and that gives us
33,300.
how much?
33,300.
33,000.
Yes, sir.
Look,
I just typed it in.
The sales are 78,000, correct? Minus
44,700.
40. Is it 44 or 45?
44.
Why do they have 45? There must be a mistake.
Yeah.
Yeah. Just I'll do the one that you have. And equal to what again? This one. What we just did. This one.
33,300.
33,300.
Yes, sir.
All right. This is gross profit under the FIFO. Okay. Now under the LIFO, let's go back to the LIFO now. LIFO. So let me increase that and underline it and bold it. All right, let me bold this one too. Now under LIFO, the sales are going this way. The last thing we get in must be sold first. So sales, first we have to sell the 300 units, then we're going to sell the 800, then the 400, then the 150. So last in, first out. We start from the bottom, going up. Yeah.
So we're gonna sell the June 4 person. We're gonna sell all but two. We're gonna sell half of that. Right?
We need 350 units
Yes,
that
yes.
haven't been sold.
So we need
150 from here
and 200 from that.
and 200 from, yes sir. So ending inventory using the LIFO is 150 times 30. 150 times 30. How much is that?
That's 4,500.
4,500. And then 200 times 33 times 33, and that is equal
6,600.
6,600. Therefore, ending inventory is equal to 4,500 plus 6,600.
11,100.
So ending inventory is equal to 4,500 plus 6,600, and that's equal
11,100.
11,100. All right, so this is our ending inventory under the LIFO. So cost of goods sold is going to be available for sale minus 11,100. Very simple. The available for sale is what? 58,200. See, once you find the only thing that changes, make this figure change, is ending inventory. So one more time, 58,200. 200 minus 11,100 equal 47,100 exactly. 100. All right. Now we're going to find gross profit or margin. Is our sales the same one that we had already? Sales
Minus cost of goods sold.
minus cost of goods sold equal gross profit or margin. In this case, our sales are
78,000.
78,000 minus
47,100.
47,100, and that's equal
30,900.
30 exactly 1,900. This is our gross profit or margin. So that's answering the question number 1. Question 2, accounting, how do you connect that? Explain the differences in gross profit. Why do we have a different gross profit under the 3 methods?
Because we have different ways of conducting the ending inventory.
Yeah, and what is the implication here? Because we have different prices. You know, if you notice that in some cases we use the oldest prices, and in some cases we use the newest prices. The newest prices are usually higher than the oldest prices. That's the explanation for that. And therefore, definitely you're going to have a different, sometimes you have higher cost of goods sold. If you have a higher cost of goods sold, then your gross profit is going to be lower. If you have a lower cost of goods sold, you're gonna have a higher gross profit. All right. So I think this example really gave us a comprehensive review of the cost flow assumptions. Now we need to do retail to cost, or cost to retail inventory, and gross profit method. So to do that, we're going to go to question E8A. E8A on page 292. We're going to do a, E8A. E8A. Bold. Okay, E8A page. Which page is it?
292.
Page 292. Now, when what you and I covered earlier before they came, remember the retail that we depends on the cost of goods sold formula. Beginning inventory plus purchases equal available for sale, and then at both at cost and at retail. And then once we find the ratio, cost to retail ratio, okay, we use that. We say that the cost is that ratio out of retail. Okay, then we deduct our sale. Okay, at retail, then we're left with ending inventory at retail times that ratio, and that gives us the estimated cost of inventory. All right. So let's take a look at this example. Let me just put, okay, here beginning inventory at cost. Let me put here at cost and at retail. All right. Beginning inventory at cost is what?
40,000.
Okay, 40,000. At retail,
And retail is 60,000.
60,000. All right, and then purchases, net purchases at cost
140,000.
140,000, and at retail
220,000.
220,000. All right, and then we notice that we have freight, and the freight should be part of what? Freight in.
Freight in is at
Yeah.
cost for the cost.
So freight in.
10,400.
Freight in is what?
10,400.
2,400. 10,000.
Yeah, that's what I said.
10,400. Now we add the available for sale. So the available for sale is going to be all of these and all of these. Okay, so we have 190 to 280, correct? 190. Let me put a line under these two. Underline, underline. Okay. Now, if we find the cost to retail ratio, what is the ratio of cost to retail? Cost to retail ratio is equal to 190,000, 190,400 divided by 280,000. All right, and that's equal what? 194,
Oh, 190.
190, 400,
I thought, yeah.
1,090,400, 190,400 divided by 280,000, what do you get?
You sure it the other way around? Oh, yeah.
Yeah, cost to retail.
Oh, yeah.
190,400 divided by 280,000.
Oh, it's 68%.
68%. All right. So, how much our sales?
68%.
How much our sales? How much our sales?
Sales.
Okay, notice, read from the beginning. Warmer's Dress Shop had net retail sales of 250,000. You see? The first paragraph.
Oh, okay, 250,000.
So the sales are 250,000. So 280,000 minus 250,000. Okay, why did we minus?
Because that's the retail.
The available for sale is 280, correct? We sold 250 out of those. So our ending inventory at retail. Ending inventory at retail is
30,000.
30,000. All right, let me put a line under this one. Now we will apply the ratio. See, this is ending inventory at retail. We are looking for ending inventory at cost. You see what I'm saying? We are looking for ending inventory at cost. Okay? How much, what percentage of the retail is it?
68.
68%. So, if you multiply 30,000 times, let me write down here, 30,000 times 68%, 0.68 equal, what do we get?
So you said, oh, 30. I'll just write the equation now.
Okay. I'm counting, you are my helper today with the numbers.
Extra points.
Extra point for tutoring them.
20,400.
20,400. That is our ending inventory at cost. And that's estimated, all right? Let's make sure that is our estimated ending inventory at cost. All right? So 20,400 is our estimated ending inventory at cost. Got it?
Yes, sir.
All right. We need to do the gross profit method, and the gross profit method is
290.
E9A.
Yeah, 293.
E9A. So let me go down further. E9A. E9A.
Gross profit.
Let me bold this one. And up. Okay. This is page 293. Oops. All right. Again, also the gross profit method. What are we looking for in it? Also, the gross profit ratio is going to be given to us. So if we have our sales are such and such, and well, if we find our gross profit at retail, once we take this ratio out of it, whatever that ratio is, it will give us the estimated ending inventory. So let's do like what we did with the first one. So beginning inventory, let me do the same thing like what we did at cost, and let me take it back. We don't have here at cost or at retail. Guess why? Because we're just looking at gross profit. We're not looking at available for sale and okay. Beginning inventory is, well, I'll take it back. It's not what we are looking for available for sale. Okay, and we're just looking at gross profit in this case. Yeah. So beginning inventory. Beginning inventory is what? 45,000. Okay. And then purchases. Purchases are, oops, I put it in the wrong place.
Purchases, 280,000.
Purchases, wait a minute.
Yes. Purchases of 280,000.
Okay. But do we have freight?
Yes, sir.
Yeah, that means you have to
Add it.
add the freight to it.
Oh, well, I thought
Purchases.
I thought it was gonna do that on another line.
No, including freight. Purchases, let me see, F2. Purchases, including freight.
Freight in.
Yeah, including freight in.
So that's 280,000 plus 13.
What do you get?
293,700.
Yes, 293,700, and let me put a line under it. Okay. Now, what is the available for sale? Available for sale is, add those two.
Yes, 338,700.
Yes, sir. 338,700. All right. So, what are? Let's take a look at these numbers for a second. For the year until date of the fire, Patel's company had sales of $450,000. Okay, and purchase of this much. Freight in was that much. And beginning inventory. Patel always priced his goods to achieve a gross margin of 40%. So, if the sales are 450,000, okay, 45% of that is, 40% of it is gross profit. That means the rest of it is cost. See, if you take the profit, the markup, out of the total sale, what's left over is your cost. So the sales are,
450,000.
okay, sales,
Excuse me.
let me just say, place it. Sales minus gross profit, gross profit equal cost of goods sold. Equal cost of goods sold. So in this case, the sales are 450,000 minus, how much is the gross profit? 40% of that.
Oh, 180,000.
All right. Minus 180,000, and that gives us 450,000 minus 180 is
270,000.
270. 1, 2, 3. So the available for sale is 338,700, and we sold 270. So our how much minus? Let me put a line under the 270. Okay, 338,700 minus 270. What do you get?
What did you say? 338.
338,700 minus 270.
68,700.
All right, 68,700. All right, what is this? What is the question is asking us?
That's your estimated inventory loss.
Loss, yes, sir. This is how much was lost. 68,700 is the estimated loss.
Minus the cost of goods sold.
Estimated loss 68,700. Now, guys, this available on YouTube. You just go on YouTube and click and type in the search engine MSBC 102. This will come out, today's lecture, yeah, so far. I think now we covered inventory in details. The next topic that we will be covering is cash control. How do we control cash? But before we do that, I want to spend some time with you on exam 1. How far are you? I'll give you a minute to finish this thing. Yeah. I was going to say, let me go and get a sip of water, but I'm fasting.
No. Oh, yeah, dang, you can't even drink water.
No, not even. We have tomorrow and Thursday, and then it's over.
So how long you feel like y'all?
30 days. And on Thursday will be 30 days.
Y'all can't eat or drink for 30 days?
But you can eat in the evening.
Oh, you can eat, you can't eat
Yes.
in the morning.
You stop. You fast from 4:30 a.m. until 8:25 p.m. No food, no drink, no nothing. Yeah. So you're talking about 18 hours, almost 16 to 18 hours.
I gotta be sleep because I just can't stay up and think about me being hungry. I got to go to sleep.
Yeah. So did you all get that so far?
Yes, sir.
All right. I want you to have you gone through the test?
Yeah, a little bit.
A little bit.
Did you have any difficulty in any question?
I was looking at.
Tell me if you have a difficulty in.
I was just looking at cause I like to make stuff make sure and stuff. I was looking at the first question was Brett's Barrett Company's owner's equity equals 1/4.
Okay, this one.
Yeah.
Okay. Do we have a question? Let me see if we have a. Let me do something in this regard. The key. Okay, this is test material. Test material. Okay, this is under test material now. Bold. And okay, the question is saying Barnett Company owner's equity equals 1/4 of the company's total assets. The company's liabilities are 390,000. What is the amount of the company's owner's equity? The key to this question is the application of the accounting equation or the balance sheet equation. What is the balance sheet? Don't guess. If you guess, if you guess, don't say it. The balance sheet equation.
Assets equals liabilities plus owner's equity.
Yes, sir. Very good. Yeah. I want you guys to remember that by heart. Yeah.
Yeah, I was thinking
So
about that, but
that's the key. Is assets equal liabilities plus owner's equity. All right. So they are telling us that
we only have
owner's equity is what?
1/4
1/4 of
the company's total assets.
total assets. Okay. And we know the liabilities, correct?
Yes, sir.
How much are the liabilities?
Liability 309,000.
Okay, is that the only figure that we know?
Yes, sir.
All right, so I'm going to assume that liabilities equal 50,000. All right. I'm gonna assume liabilities. I'm not gonna tell you what they. For this one, well, I'll do something similar to that and take a note.
Yeah.
Okay, but I'm instead of fourth, I'm gonna say third. Okay, owner's equity is owner's equity is equal to third
Of the assets.
of the assets, or 33%. Okay, or
Referring to the actual equation, it would be
33%. Okay,
1/4, 25%.
got it?
Yes, sir.
And what? How did you try? Did you try? First of all, did you try to fix it?
I was trying to like plug it in, like solving, like type solving for x, but when you got two x's, it's like because you don't know the owner's equity. I try to reverse it, like owner's equity equals assets minus liabilities too. I try to like do it that way too, but I still couldn't come up with nothing.
You couldn't come up with an answer? All right, let me show you how we do that. Very easy. If you think of it, very easy. A equal assets equal liabilities are what? 50,000? 50,000 plus 0.33 of A. Now does that click? Find A first. Find A. A equal 50,000 plus 0.33 of A.
You gotta divide the A out. So you go 0.33 equals 50,000.
A equal what you just said. A equal 50,000 divided by 0.33, and that's equal A equal
I'm getting 151,515.15.
just do. Let me go back myself to the thing. So let me go. Okay. 50,000 over 0.33. What did you get?
I got this one.
Correct. 151,000.
What is the assets?
151,515. I'm done. It's okay. We don't need the point 15. So now we know the assets and we know the liabilities, correct? So assets are 151,515. Assets equal. Liabilities are
50,000.
50,000 plus
1/3.
owner's equity.
That's 1/3.
Isn't that easy? That's how you solve that question. See, this is an application of the application of the formula, the balance sheet formula, and at the same time your cognitive ability, application of algebra at the same time, yeah, your cognitive ability. Yeah.
Okay. So I got 49,000.
Yeah, so apply the same method to the question in our question, yeah. But instead of 0.33, it is 0.25, yeah. All right, next. Do you have any difficulty in other ones?
Question 2 is fairly easy.
Question 2, yeah, that's just say,
Determine the net income
okay, what's the,
or loss for each year.
huh?
That's all you can do is just list assets minus liabilities.
Which one are you looking for?
Question 2. No, I was saying like determining the net income, like especially for the first one, that's all we gotta find because there was no investments and no withdrawals.
Oh, we've done like that before.
Yeah, that's what I'm saying.
Yeah, find the owner's equity at the beginning of the year and at the end of the year.
Mm-hmm.
Guys, we did that on the chapter 1 assignment.
Yeah.
Exactly, yeah.
Yeah, that's what I'm saying.
That's easy, yeah.
That's really easy.
Mhm. And what's next?
Question 3 is just decide whether we debit or credit
Mhm.
something. So.
It's just this application of the rules, the double entry
Mhm.
rules. When assets increase, they are debited. When they decrease, they are credited.
Mhm.
Liabilities are the opposite. When they increase, they are credited,
And they decrease their debt.
debited. And owner's equity depends on the account.
Mhm.
So the capital increase by credit, decrease by debit. Revenues increase by credit, decrease by debit. Expenses increase by debit and decrease by credit. And withdrawals, they increase by debit and decrease by credit. Yeah. So
This was the first thing we learned, right, with the balance sheet, right? Well, the T chart, right?
yes, sir. Yeah.
We got
Those are the rules of the double entry system. Yeah.
So they got like we got here. So capital, if it goes up, it's credit. If it goes down, it's debit. Expenses, if it goes up, it's debit. If it goes down, it's credit.
Yes.
Okay, right there.
That's how you just need to know. Let me just tell you one thing. Accounts payable is a liability. Let me just is a liability. Land is an asset. Land is an asset. Owner's capital is owner's equity. Unearned revenue. What's unearned revenue?
Unearned revenue is like services you guys still gotta complete. Like,
Tell me, is it
invoice?
is it assets, liabilities, or owner's equity? Unearned revenue.
It's a asset. No, like,
It's a
it's
liability.
a liability because you haven't
Liability.
completed.
Because you didn't get it yet.
Yeah, he said it by firmly.
Yeah.
Liability. All right, it's a liability. Interest payable.
Decrease the interest.
What is? Just tell me. It's a liability.
Mhm.
Prepaid insurance,
That's an asset.
an asset. Wages expense,
That's a
owner's equity. That's going to reduce owner's equity. Yeah. Art supplies.
Decrease
Art supplies is asset. You say it with confidence. Huh? Yeah, don't guess. Say it with confidence. Advertising fees earned.
That's an asset.
No.
Increase
That's
in
revenue.
advertising. Oh, revenue.
Yeah, earned from the word earned. Yeah, that's a revenue.
That's number 3.
But we on question 3, we going down the line.
Yeah. So what's the next question?
Indicate whether each account below has a normal debit or a normal credit.
Now, let me just mention this for this question. All assets, all assets,
You go.
all assets has, what's the normal balance of all assets?
Debit.
Yes, sir. The normal balance of liabilities,
Credit.
credit. Normal balance of withdrawals, capital.
Capital. They are
Credit.
credit.
Credit. These things don't guess.
Yeah.
You have to know it by heart, yeah. Capital, okay. Withdrawals,
Debit.
debit, yes, sir. Revenues,
Credit.
credit. Expenses,
Debit.
debit. I think that concludes all of them.
So this guy write normal debit, normal credit next to them. That's it.
Yes,
Number 5, we just do the journal entry.
Yes.
Right?
Number 5 is doing journal entries. Got it? Okay, how many days you need more for the test to do?
I'm gonna finish this today.
Okay. Don't forget now 3, 4, and 5.
Oh yeah.
Chapter assignments.
No, I'm gonna turn my stuff in, and I'm gonna have the case studies ready for you.
Yes, sir. Guys, don't forget chapters, assignments 3, 4, 5. They are all open. They are all open. I'm going to add 7. We still.
I still got to click on 2 on.
Now you gave me the cases.
Yeah, I gave you. Oh, okay, I gave you.
Yeah, give me the cases, but only 1 chapter assignment from you.
Okay.
Yeah, I need chapter, the rest of the chapter. I think I'm going to give you the balance of the time on working on the test and the chapters assignments. Use the balance of time for that because I don't want to start chapter 8 at this time. Yeah. So hopefully by the grace of God tomorrow we will do chapter 8. Got it?
Yeah.
All right. So let me stop the streaming.